Today, we are going to learn about the commercial banking growth advisor's role. We want to unlock the potential of the commercial banking growth advisor. Therefore, the portfolio audit is a growth tool. It's not anything else but a growth tool. And the audit is not the product. The truth it uncovers, and the action that follows is. So let's dive right in. Who this lesson is for, who this program is for. We have three audiences. One, agent need, growth, commercial, lending safely. Let me go over again. We have three audiences. One, agent need to grow commercial lending safely. Experienced bankers benefit from this course, especially those who are working to turn their 10 to 20 years of lending, credit, or leadership experience into a premium consulting services. The second class of people belongs to the rural and the community banking system. To grow commercial portfolios while tackling NPLs or non-performing loans and capability gaps. The third class of audiences fall under the microfinance institutions. Move from group lending and microcredit to SME lending without taking unnecessary balance sheet risk. So, if we look at it, we have three audiences. Let's dive in further. Before we go deeper, why are banks afraid of portfolio audit? Why are banks afraid of portfolio audit? What makes the word audit uncomfortable to most of us, especially the bankers and those who are in question? We have two answers there that we have to look at. The first one is A. It feels like blame and regulatory exposure. It feels like blame and regulatory exposure. And B. It reveals facts management may not have quantified. So if we make a true comparison of the two, both can be true. The advisor model reframes the audit as a growth tool, surface problems so they can be treated. Are we getting it? Let's move on. The 4 layers of a portfolio audit. You will need all 4 to see the whole picture. Meaning if you have looked at level 4 without looking at level 1 or 2 or 3, there is a red flag. If you look at level 3, you don't look at level 1, there is a problem. If you look at level 2, you don't look at level 3, there should be a problem. So what are these levels we are talking about? The first one is quantitative. Number 1 is quantitative. Under the 4 layers of a portfolio audit, we handle number 1, quantitative. What the numbers of the business or the customer really say. What are the numbers saying, and what is the picture we are seeing? The qualitative is the number 2. The qualitative is about why the numbers look that way, whether the numbers look good or the numbers look bad. The qualitative reveals and exposes the anomalies. Number 3 has to do with behavioral patterns. Those patterns that are strongly aligned with the behavior of the client and the comportment on his or her account is behavioral. How many management behavior creates or repeats risk? How many tolerated indulgences repeat a risk? not only to the customer, but first to the bank and then to the customer and to the wider community. Number 4 is the environmental patterns, what the market and the regulation are doing. Are we running this market in line with the regulatory guidelines, or we are doing it opposite to the regulatory guidelines? That is what the growth advisor, the growth person wants to know before they move on. According to layer 1, there is one thing we must do and do thoroughly well. You have to interrogate the loan tape. The loan tape before. If the institution cannot produce a complete extract, that is already a finding. So the loan tape reveals the transactions, the loan issues of the customer. That is to be first and foremost considered before the next step. So request the full loan tape in a spreadsheet format so you can look through, investigate, and do your findings. Number 2, review outstanding balance, sector, disbursement dates, next payment, arrears, classification, and collateral. If you don't do this, you will miss out. And the third is calculate the true NPL, or the true non-performing loan ratio, using 90 plus days in arrears as non-performing, and flag restructured class facilities for separate review. Are we communicating? Let's move on. The 4 quantitative questions that we have started still continues. Turn a spreadsheet into a management story. That is what these questions seek to do. These questions seek to help us turn the spreadsheet the customer provided or we pulled out into a management story. So the first one we consider, as we can recall, is the NPL. Number 1, the non-performing loan. What is the true level of non-performing loans? Are they doing well? Are they now developing signs of going into an NPL level? Number 2, concentration. Where is the portfolio overexposed by sector or borrower? Sector 3, maturity. Where are the next 90-day and 12-month repayment cliffs? Number 4, is actual portfolio yield matching the stated pricing? These are things you have to look for. When you look for the concentration, you try to find a portfolio overexposed by sector or borrower. You also move on to the maturity, where are the next 90-day and the 12-month repayment cliffs? Is actual, the yield exposed, whether actual portfolio yield is matching the stated pricing? This is interesting. So we have to look at all this to perform a healthy portfolio audit before the next steps. So concentration risk, the expansion of the concentration risk is to find the hidden giants. Small percentages can hide big exposures. Therefore, we do a sector examination and a single borrower examination. During the sector examination, we sort the outstanding book by sector. This is the source flags. The source here flags more than 30% in one sector as a concentration risk requiring management discussions. The single borrower aspect also is sorted by a borrower. In that case, the source flags any borrower representing more than 10% of the portfolio for immediate attention. So now, after that, we are heading towards findings that get management to act. Findings that get management to act. It means during portfolio audit, don't just report problems. You have to make the next move obvious. So under we have three aspects. You have three critical moves to make here. First, the critical move is immediate action must follow the findings to address it. Regulatory risk should be avoided before it sets in, and major financial loss exposure should be checked, and reputational threat should be avoided. And one important thing here is that action within 90 days must be key. Serious structural issues must be avoided and facilitated, and then not yet an immediate crisis. So the observations stage will look at the longer term improvement and the useful recommendations, not urgent but careful, so that it will not hurt but help. So the audit has a lot to do. As an advisor or auditor, don't explain. Which statement makes you more valuable to management? Which statement makes you more valuable to management? We have statement A and statement B. Statement A says 23 files have incomplete collateral documents, and statement B says 23 files are incomplete. Refresh valuations within 60 days and starting with 11 stress or near maturity facilities. When you look at these two, they are both revealing problems, red areas to be looked at. But as a leader, a teacher, I will advise you stress more on question B because it is more detailed. Sentence B is more detailed, more precise. So management identifies, knows the loopholes, where to follow, what to do to regularize and make a clean note and a clean sheet that will merit an approval or a continuation of a healthy facility. Let's move on. But after all this, when everything is clear, there is a next step. We call it the pre-engagement conversations. Before you even sit with the customer, start the transaction discussions, set the tone before you touch the portfolio. Set the tone, do your findings, do your homework, go through the basics, do the audit checks. Then you set the tone before you touch the portfolios. Position the audit as a growth tool, not a blame exercise. Prepare leadership for uncomfortable findings so they will not be shocked to the brim, and ask for the institution's top 3 portfolio concerns. When you are aware of those, you will measure up and use them for whatever audit you are doing, and review recent regulatory concerns and make sure you have not they don't slip or you don't overlook them, and then ensure that you agree on reporting lines, weekly updates, and final report approval. When all that is done, we have the next move, 30-day advisor challenge. As an advisor, within 30 days, there must be things you must do in a month. Your first engagement should produce movement, not a tick report. So it is not about the audit report that matters. The steps that will lead to a good activity and a good portfolio, that is what matters. So in the first week, get the loan tape. In the second week, set a scope. In the first week, get the loan tape, set a scope, and align leadership with everything from the beginning. In the second week, run the 4 quantitative reviews, start file testing to find the hidden things management is interested in. And in the third week, complete qualitative, behavioral, and environmental reviews to ensure you are on course, and by week 4, bucket findings, you have to expose, attach numbers, and bring solutions or suggest solutions that the appropriate officers and yourself will have to make it up to the bank. You have to ensure it is done, they are correct, everything is intact, so that there will be no problems lingering here and there. If you have done this, you are an advisor with a promise. The advisor's promise is he or she. You will tell the truth, you will quantify it, and fix what matters first. And so that comes about the growth mindset, the growth advisor mindset. The portfolio audit is not the end product. It is the starting point for a better portfolio, better decisions, and a better management action. Are we communicating? Thank you so much for staying by. See you on the next one.